You know, in the business world, sometimes the biggest changes don't come from a flashy product launch. They happen quietly, deep inside an accounting rulebook. Today, we are diving headfirst into one of those huge, under-the-radar shifts. It's a new standard called ASC 842, and trust me, it completely changed the game for how companies report the things they rent.
So, let me just ask you this. What if a company you were thinking about investing in had billions of dollars in financial commitments? We're talking basically a form of debt that you just couldn't see on its main financial statements. Well, for a long, long time, that wasn't a what if. It was just reality. And the reason for that reality? It all came down to something called off-balance sheet leases. This was the core problem, this hidden debt that these new accounting rules were really designed to fix. So let's take a quick look at how things used to be.
I mean, for decades, a company could go out and sign a long-term lease for, say, 100 storefronts, a fleet of airplanes, or a ton of office equipment. And these massive financial promises, they wouldn't even show up as a liability on their balance sheet. Nope. They were just tucked away in the footnotes, making the company look a whole lot less risky than it actually was.
And that is exactly why this new standard was such a big deal. The main goal, and this quote really hits the nail on the head, was all about transparency. It was about dragging those hidden promises out of the footnotes and slopping them right onto the balance sheet for everyone to see. So, we've talked about the problem. Now let's get into the solution itself, ASC 842. This standard wasn't just a small update. It was a fundamental rewrite of the rules, all designed to give us a much, much clearer picture of a company's real financial health.
And just look at the difference here. I mean, it's night and day. Before, only this very specific type of lease, a capital lease, which was basically just a disguised purchase anyway, made it onto the balance sheet. But now, under ASC 842, pretty much every single lease, from your local coffee shop's building to a major airline's fleet of jets, has to be on the books.
So how does this actually work? Well, when you break it down, it's pretty logical. When a company signs a new lease, they now have to record two new things on their balance sheet. First, something called a right-of-use asset, and second, a matching lease liability. All right, first up is the asset. Now, a right-of-use asset, or ROU asset for short, isn't the physical thing itself. It's not the building or the car. It's the right to use that building or car for a set amount of time. It's this intangible asset that basically says, hey, we have valuable access to this thing.
And of course, on the other side of the coin, you've got the lease liability. This is the company's promise. It's their legal obligation to make all of those future lease payments. It's basically the total price tag of the lease, all calculated in today's dollars.
Okay, so if you've got to put all these leases on the books, it becomes absolutely crucial to know what actually counts as a lease, right? Well, ASC 842 boils this whole thing down to two key questions you have to ask about any contract.
The whole concept really comes down to one word: control. A contract is a lease if it gives the customer the right to control the use of an asset. And to figure that out, you just have to answer two questions. First, is there a specific, named asset involved? And second, does the customer actually get to control how that asset is used?
Let's break down that first question a bit. An identified asset could be super explicit, like a truck with a specific VIN. But here's the key test, and it's all about substitution. If the supplier can just swap out that asset for another one whenever they want, and it actually makes sense for them to do it, then it's not an identified asset. And if it's not an identified asset, it's not a lease.
Now for that second question, right to control. This table here breaks it down perfectly. There are two parts to it. First, the customer has to get basically all of the economic benefits from using the asset. And second, the customer gets to call the shots on how and why that asset is used. So, if you get the rewards and you make the decisions, you've got control.
So you might be thinking, okay, great, all leases are now on the balance sheet. We're done? Well, not quite. There's one more crucial distinction we need to talk about. Because leases come in two different flavors, and that flavor has a big impact on a company's income statement.
Yep, these two types are called finance leases and operating leases. The easiest way to think about it is that a finance lease feels a lot like you're owning the asset, while an operating lease is more like a simple rental. Now, both of them create an asset and a liability on the balance sheet, but the way the cost shows up on the income statement is totally different.
And you can see that difference so clearly here. With a finance lease, the expense is split in two. You have amortization and you have interest. This means the cost is front-loaded. It's higher in the early years. But for an operating lease, it's way simpler. It's just one single consistent expense every single year.
Now, this might sound like a tiny accounting detail, but it can really change how profitable a company looks from one year to the next.
All right, let's bring this all home. Why should any of this matter to you if you're not an accountant? Well, because bringing literally trillions of dollars of hidden obligations onto balance sheets has a massive, real-world impact on how we all analyze companies.
I mean, think about it. Suddenly, a company's total assets and total liabilities could just balloon overnight. And that directly messes with all the key financial health ratios we use, like the debt-to-equity ratio. A company that looked pretty lean before might suddenly look way more leveraged. It even changes popular metrics like EBITDA because of how the expenses are now classified.
And we're not talking about a minor adjustment here. For industries that live and breathe leasing, think retailers with all their stores, airlines with their planes, telecoms with their cell towers. This change added billions, sometimes tens of billions of dollars in new liabilities to their balance sheets. It gave us, for the first time, a much more honest financial picture.
So we'll end with this thought. By dragging all of these hidden obligations out into the sunlight, ASC 842 forces us all to see companies for what they really are, all their commitments included. So the next time you look at a company's financial report, you're not just getting part of the story, you're getting a much more complete one. And seeing that full picture, well, it changes everything.